Hello and welcome to Investing Confidential. 2022 was rough. I mean, obviously, most people lost money. Certainly, what's interesting about 2022 is it didn't feel as bad as it was. If you look at, obviously, you see here $30 trillion was lost between stock and bond markets. When you look at it in historical perspective, I mean, on a chart, I mean, it's brutal. I mean, this was the combined worst than 2008. Okay, combined worse than 2008. Does it feel like it was 2008? I've lived through starting as a young kid through the crash of 1987, which was 22% down in one day. We haven't seen anything close to that yet, and numerous other crashes and bear markets. I got to tell you, this 2022 was on paper, including bonds and stock, the worst in maybe in history in terms of combined dollar losses, for sure the worst, but didn't feel as bad as it actually was because the losses were in, you know, stocks that had gone up dramatically over the last 2 years. So we haven't even, but the sad thing is we're not even back down to where we should be in terms of right before the beginning of the pandemic, which is where everything should base. Okay. Since the pandemic, we need to erase all the excess, erase all the crap, and get back down. I mean, stocks need to test. I still think stocks are going to test the 2020 lows. I know everyone wants to hear that, but that's basically where I think the base is going to be, in the medium term. But for now, I mean, you normally, I mean, you have big losses like that in one year, you get a rebound normally, but this isn't normal. Okay, and we're going to talk about why. But look, some of this was dramatic. I mean, look at these meme stocks, which some of you probably traded. It was amazing moves in these stocks for a while. Not only have they reversed, they've gotten destroyed. Okay, on a whole, all these meme names with AMC, GameStop, all this destroyed, absolutely destroyed, and the hedge funds were destroyed with them. Obviously, very few, if any, of these hedge funds were able to stay short. They got destroyed, and then consequently, everyone else got destroyed. So again, 2022, complete disaster. In terms of just performance of everything, okay. And the bottom line is, this was very easy to see. Okay, in the beginning of 2022, the signs were there. Rates were going to go up. And, over the last 30 years, okay, people made money by saying, don't fight the Fed, buy the dips, don't fight the Fed, don't fight the Fed. Well, that still matters today. Don't fight the Fed. Powell's in charge. He's a moron, but he's in charge. And the Fed is raising rates, and nothing's going to stop them right now. They can't, and because the indicators are, and inflation may be coming down, okay, but there are other things happening which they not come down as much as you think. So, what's affecting inflation, interest rates, the consumer, everything has been affecting which is the economy. But what's the reality? Okay, what's going on in the economy that really have people worried about 2023? And it's not just a question of buy stock markets when they're down and hopefully rebound in 2023. The economy is in really bad shape. And if you look at leading indicators, which I think you have to start doing, okay, leading indicators are published. They're actually pretty reliable, because they look at a lot of what I would call data sets rather than trying to poll people. And so if you look at these leading indicators, they were down, they're showing down, they continue to show down. How's it calculated? Look at these contributions. You can just see here where all of the different things that matter in the economy for the future um, are. And the last ones we calculated was November. So obviously the stock market is up. It's going to be down again because the stock market got crushed in December. So leading indicators will continue to trend lower, and this is not good for the economy, because this is an economic indicator, and obviously stocks. Uh, Another reason, look, small businesses, which are the engine of growth for this U.S. economy, and probably you could say that statement for globally, they're the largest employers. They employ much more people than big businesses. Look, small business hiring is down. Small business hiring is a leading indicator for the future. They do not see a ripe future. Therefore, they're not hiring people. They're actually firing people, and that's not good for the economy. Consumer sentiment. I've talked about that till I'm blue in the face on these videos. Consumer sentiment is down. But here's another interesting indicator. Consumers now because of the sentiment, they're not saving any money. In fact, they're drawing down savings. So this is one of the worst savings environments we've ever seen. It's not good for the future. It's not good for consumer sentiment. It's not good for housing. It's not good for anything. It's not good for large purchases like cars. This is bad, folks. This is really bad. And until that savings rate stabilizes and starts to go up, we're not going to see any kind of rebound in the economy. And the yield curve tells you right here. We've talked about the yield curve. You heard it, the twos and tens. The Fed has crushed the yield curve. Okay, and this is the fastest tightening we've seen in 50 years. The yield curve. It's an indicator. We are 100% sure going into recession. Okay, I don't care what Wall Street says. 30% chance. No, it's 100% chance. In fact, there are some saying we already in a recession, as I've been saying. Now Michael Berry and some of these other guys coming out, but there's 100% chance we're going into discussion is how long is this recession going to last? But the yield curve, when we go into recession, will reverse, which is, a leading indicator. The question is, if the yield curve doesn't reverse when we go into this recession, what will happen then? It's just going to extend it. So the Fed has caused it for obvious reasons. They had to. They had no choice but to. And they've knocked inflation down a little bit. Inflation is off from the highs, but it's very sticky. It's a word I've used for a while. And this is the main reason why the Fed is not going to reverse anytime soon. You look at wage growth here. This is global wage growth, but look at the U.S. Wage growth in the U.S. is the largest in history. Now, this is good, okay, for people making minimum wage and others, but this is not good for inflation. Okay, we know that there are a lot of businesses like hospitality that need to raise raises. There, you can't survive in this country anymore at minimum wage. It's absolutely a disgrace. It needs to go up. I don't know if it needs to go to $22 like California, but no matter what it does, it's going to keep inflation going up. So people will have more money because the inflation is going to be up, and food and everything else is going to cost more. So the wages have to go up. They have to. And look, and this is another reason why long term. Look at this. This is an interest. These are interest rates going back to the 1800s. I mean, we're at a turning point here. Okay, but as you can see with these movements, they're not 1 year movements. There's a long way to go before rates start to peak again. Okay, so I don't care what Jim Cramer, these morons on Wall Street tell you, it's not going to happen this year. Okay, bear market, bear market in bonds, which is what you're seeing here, lasts for a very long time, and bear market bonds affect stocks, as we saw. So, market in 2023, what's going to happen? Wall Street, basically, you can see here their forecast. They say it's going to go up. They always say it, and they're always wrong. They're always bullish. They're always bullish, and they're always wrong. So, as you can see here, they have everyone's forecasting a higher S&P. Just go against them, and you're going to make money. Okay, if you can short the S&P at some point with your timings right as a trader, you can get away with that. Okay, Kramer and CNBC and those other idiots are telling you buy tech. It's because it's down. I mean, look, that's it. Look, you don't need to watch these shows or pay for financial advice or someone to tell you that tech is down, buy it the next week. But it's not that easy. Okay, for the first time in ever. Okay, we've had since the tech crash. We've seen tech companies just firing people. I remember the tech crash. It took 10 plus years, maybe longer, for that to recover. 15 years for the market to recover. 10 years for the tech industry to recover. So the tech industry is shedding jobs. And again, this tells you it's going to last a lot longer. And look at the U.S. market here versus the world, against global. U.S. is still very overvalued. Okay, we need, and this is after one of the most horrific years ever. But U.S. is going lower over time because it's still overvalued. And let me give you some inside baseball here. Look at the S&P total return attribution. This is what affects the returns of the S&P, all these different factors. PE multiples was the biggest last year. It's going to continue to be the biggest. PE multiples, as we saw in the chart before, are still very high, and they're coming down. And so will earnings. Okay, earnings consensus. Wall Street is wrong. They're going to have to bring earnings down, and that's going to be another contribution to a negative S&P. When you have negative earnings, what does that count? That means dividends are down. So all of this is going to contribute to another difficult time in the market. And, when we talk about business conditions and economics, this is really important. Here this is a chart that I put together. Global recession. Okay, I use someone else's chart and just put in where there's recessions around the world. All the major countries are in decline, except for India. Okay, large companies here in this country, whether it's Apple, whether it's Honeywell, whether it's General Electric, whether it's Exxon, they all sell to all these countries, and every single one of them, all these big economies, they're all in recession at the same time. I don't think in my lifetime I've ever seen this before, because usually China is doing better, the US is down, China does down, Germany was always, everything's down. This is not good. Okay, and what's contributing to all this is a theme that I really believe is that globalization, folks, is dead. Okay, globalization, which has really driven this deflationary or lower interest rate environment driven by China coming into the WTO in the early 2000s, that's gone. All those benefits we've seen already. Okay, there's 450 trade agreements. There can't be any more trade agreements. So all that benefit is gone. Not gone, but it's already happened already. So what does that mean? That means it's inflationary. Globally, it's inflationary. When globalization dies, it's inflationary. All that also means there's more capex. Companies need to spend more because the globalization is dead. So as we're seeing now, we want to build semiconductor plants in Arizona. We want to build them in Mexico. We want to move all the manufacturing back here. What that means, companies have to spend more money, more capex. More. What does more capex do? Any analyst worth their salt will tell you higher capex means lower earnings. Okay. And this is a problem. Again, contributing to PE multiple contraction. Right. This is what I'm talking about. But look, it's not all bad. There are some interesting parts. Again, this is for traders. Okay. Look at this put call ratio. People are massively bearish. In a sense, they're bearish, meaning they're hedging. They're not selling stocks whole, in panic, but they're just buying a lot of protection in the form of puts. What does that mean? That means that we're going to see continued bear market rallies, violent to the upside, as we saw in 2022. But again, on the positive side, there are some places around the world that are cheap. I can tell you right now, the UK, certain smaller countries in Southeast Asia, Vietnam, Indonesia look very, very cheap. Philippines, not that you want to invest in these countries, but there are parts of the world that are very cheap. Look at Latin America here in a chart. I mean, from a valuation standpoint, and this Brazil was down massively today, so it's going to be even cheaper. But these are places where you want to take a look at, because you're going to make more money in 2023 and onward in the international markets than you will in the U.S. Okay, the U.S. dominance is over for in the short term. Okay, we're going to see much international markets outperform. But the other thing is, market dynamics are changing. Okay, the stock market, who owns the stock market? It used to be back in back before the 80s, before the explosion of Wall Street, it was really individuals, stock pickers who owned the market. Then obviously Wall Street took over in the 80s, massive. We had mutual funds, hedge funds, institutional investors, all these guys came in, dominated the volumes. But we're seeing a reversal now, as you can see here. And individuals are starting to get more active in the market. I think that trend continues. I think we're going to see reduced influence by hedge funds, mutual funds, in the form of ETFs, all this. And so I think that that's going to be a positive. As I said before, it's going to be a stock picking market going forward. And if there's the trading call I will make is, I think the January effect is in place. As you can see here, US small caps in December were killed. This is what we call the January effect. Institutions selling off underperforming small cap companies. Usually it's illiquid companies staying more liquid. And this creates a buying opportunity. So this massive sell-off in small cap stocks is very interesting, because to me, this is where the value is, where you as an investor should be doing your own homework, gathering the data you can and buying small cap companies. So as an investor, as always, be careful out there.